following is an update and technical analysis on the Russell 2000 based upon the daily interval. And as we dive into some of the latest developments surrounding the IWM, the biggest component to the Russell 2000, small caps are beginning to take center stage, showing some impressive dynamics from a pure technical perspective. Upon deep diving underneath the hood of the telecommunication stocks in particular, have outperformed their larger counterparts, rising by a remarkable 26 to 30% in Q3 2024, where this surge in telecoms has been one of the bright spots. In a market where other sectors such as energy and technology have continued to struggle, where energy stocks have taken a hit down nearly 16%, and despite some of these challenges, the overall small cap landscape has witnessed a surge in investor confidence where the IWM, the largest component ETF of the Russell 2000, saw a significant $1.3 billion inflow recently, marking a 2.2% increase in its outstanding units. Some of the largest players within the Russell 2000, including Supermicro Computer and e.l.f. Beauty, have experienced mixed performances, with both stocks facing some downward pressure. That could be the beginning stages of a snapback and or counter-trend rally to uplift and help the overall weighting of the IWM sector. Some sectors like financials and consumer discretionary have shown resilience, outpacing their large cap peers, signaling potential opportunities for investors and or traders. And I believe we've reached a critical juncture upon the 200 exponential moving average. And I believe it's had some critical component reaction and or backtesting its key pivotal inflection point, reactionary highs and lows, and that has been reflected upon each and every time it has become a demand zone. We had a similar, nice clean inverse head and shoulder classic looking bottom here, broke out with volume, and that was off to the races, backtested once again, and here we are backtesting it in the near term. Once again, you had a beautiful head and shoulder classic looking top, broke down below that 200 exponential moving average, backtested, and that ideal was good for an additional 12-point double-digit crash to the downside. Once again, you had two additional reactionary lows, third, fourth, and you get the picture. There is extreme correlation in between the 200 exponential moving average that we have seen really clearly in the past year. Additional reactionary lows. You had a sort of a whipsaw-like event here. An additional backtest, that's where you remain short with constant, complete crash to the downside, 25%. Kind of overshot, had a false breakout, backtested the 200 exponential moving average once again, and it was good for a great double-digit crash, 16% crash to the downside. Additional reactionary highs here. You get the picture. Just insane correlation in reaction, and I believe it is in correlation of some big key technical induced levels that need to be watched closely and monitored to the very microscopic level. Long traders and or bull traders want to hold this key inflection point in correlation of the 200 exponential moving average and the bottom of the parabolic inverted uptrend line, really at all cost here, and that it's had major, call it 5 major reactionary lows right off the gate there. And this could be the beginning stages for a setup of a classic head and shoulder looking top, but the neckline being the inverted and parabolic uptrend line as the neckline, could be within the beginning stages of a head and shoulder neckline short squeeze. And we had a successful big major defense of the 2054 price support, the 200 exponential moving average, and the inverted parabolic uptrend line. Call it a triple transitioning price mechanism that was bid heavily with a great hammer move to the upside that was perfect for, especially for any active and or day traders, on a big move to the upside, only increasing the odds that short sellers and or bear traders begin to become infused with fear that a potential rally could ensue on a short squeeze matter, ultimately negating the primary neckline to the head and shoulder classic looking top on a potential revisit to the 2236 price resistance level that was rejected pretty impulsively right off that open. Long traders, they want to take this 2236 price resistance level out with conviction on a solid daily green infused candle breakout above to go on to re-challenge the upward momentum primary reactionary parabolic downtrend line, and that would be the next target for reflection and backtest amongst that key pivotal level. Short sellers, bear traders are salivating at the mouth that this was a false counter trend rally and or snapback rally, where short sellers want to see a continuation of this classic head and shoulder looking top. You want to see a solid daily infused big breakdown sell signal, ultimately triggering margin calls and or stops to go off, taking out this triple transitioning price support level, and that will be the beginning stages of a big breakdown sell signal at an RSI relative strength index nearing the 40 range on a reflection and retest of the 2,270 price support level for 2.7% crash. On a decent size looking air pocket for the next target around those previous reactionary lows for 7.3% crash, down to the 1819 price support level for double digit 11.7% crash, only increasing the odds that damage becomes infused within these technical momentum indicators, undercutting their zero line thresholds, and an all-out potential panic. Small cap traders and technical traders thrown in the towel. As the small cap universe continues to evolve, IWM stands as the barometer for the resilience of these nimble and or smaller companies, with sectors like telecommunications charging ahead and renewed potential investor interest. The Russell 2000 is a testament to the dynamic potential of small cap stocks, where they're riding out temporary downturns in energy and or tech, capitalizing on the outperforming sectors. IWM remains a powerful tool for capturing the pulse of America's smaller yet impactful businesses.